My name is Hanna Szymborska. I'm from Homes England, and I'm delighted to welcome you to our winter learning programme. The series offers a series of knowledge sharing sessions on topics you have told us are of interest to you, and today's event is focusing on the housing market and the economy, current insights and future trends. So if you haven't already attended a session before, this winter learning programme is brought to you by Homes England's Local Government Capacity Centre. And this slide summarises who the LGCC are, what our mission is, and essentially we were established at following extensive research and consultation with you across local government and with a whole range of other partners to determine where authorities need most support and how this can be best delivered. And the learning programme, next slide please, is just one of the tools that the Local Government Capacity Centre offers. And the offer also includes the Housing Information Hub, which is an index of housing resources accessible via gov.uk, so anyone is able to access it, as well as fact sheets to support local authorities with the case for housing development and regeneration, as well as a capacity analysis tool, which you can use to access capacity. And all of these links should be accessible to you once you get the slides, so don't worry about noting anything down. You should have easy access to it afterwards. And of course, we do look forward to hearing how we did in the survey at the end of the session, so please do take part. Thank you very much. So next slide, please. So on the session, you will see a breakdown of the session today. So we start with a current market overview delivered by my colleague Fionnuala Early, who's a senior economist here at Homes England, followed by a section on what's coming next, what are the future trends, and we broke it down firstly to talk about the economy, which I will talk about, and then we're also going to talk about the regions and what is the outlook for housing markets across different regions, which will be covered by my colleague Fionnuala. And then around 3 p.m, we'll finish off and break for a Q&A when we would welcome your thoughts, comments, questions. So throughout, please do put them in the chat and we'll try to answer as many as we can in this segment. And we're going to finish off shortly before 3:30. Brilliant. So I will now I'm going to now hand over to our first presenter, but before I'll just very briefly mention, if I can have the next slide, please, about who we are. So why are we the experts to listen to on the topic of housing market analysis? Well, we at Homes England sit within the research and analysis team, and our job on a day-to-day basis is to understand the housing market and the economy and how it relates to decision-making at the agency, how it affects what it does, but we also look at what the agency does and how that affects the broader housing market and economy through evaluation and strategic research. So this is what we do, and I'll hand over you now to Fionnuala, who's going to talk about the current trends in the market. Thank you very much.
Thank you very much, Hannah, and hello everybody. Can we have the next slide, please? I think everyone's done the Menti poll, so if we can go to the next one, please. So I'm going to talk to you about the short term, really, where we are now, where we're starting from, before we then go on to Hannah talking about the forecasts. So we can have the next slide, please, and all will be revealed. So we know that inflation has been the big baddie that we've been facing for a couple of years now. It's coming down quite rapidly, and we should all be delighted by that. And that's because of the implications that has for the cost of living. If price growth is falling and wages are growing a bit faster, which they are, then we're making the standard of living a little bit better. And also, if interest rates are coming down as a result of falling inflation, then that makes it easier for mortgages, and it also makes it easier for people who need to borrow to get through their months, but also for companies who need to borrow to invest, and that all adds to overall growth. So we can see that inflation has been falling really rapidly. That goods line, the orange one, that's reflecting a lot of that is reflecting the fall in fuel prices, and that's what's making people feel happier. But sentiment is really, really changing. So on the right-hand side there, those market expectations, you can see, even though people were expecting fuel prices to be coming down, or the markets were expecting fuel prices to be coming down, the big difference in around about 6 months between their expectations for interest rates above 6% back in June, and now they're coming down to around 4% in about 9 months' time, or maybe 12 months' time there. So the markets are sort of ahead of what's happening with the bank rate at the moment, but that's where they expect the bank rate to be. But while inflation has been dominated by fuel costs, or falling fuel costs, I should say, what's more concerning to the Bank of England among these inflation measures is the core inflation measure, and that's the bright green one. And the reason for that is because it's a better signal of domestically generated inflation. So some of the other things that we've been facing, obviously fuel costs, a lot of that's imported inflation, and that then feeds through. But domestically generated inflation is a real worry for the Bank of England, because that suggests that we're spending more than we might otherwise do, and that pushes up prices. And it also means that transmission mechanism to get rid of inflation quickly won't be working as quickly. So things, for example, companies are reacting with a lag to those earlier increases in fuel costs, and that means that they're putting their prices up. There's been a bit of a lag; they haven't put them up straight away. And also from the labour market view of that, people whose costs of living have risen risen very quickly, and they're demanding higher wage rises. So if the hairdresser demands a higher wage, then you're going to face a higher cost of a haircut. So that all feeds into inflation. If we have the next slide, please. Now, it's not just all about hairdressers. It is about wages in general, and that's what's making the Bank of England rather nervous. If it grows too strongly, it fuels inflation for longer. And it's a bit of a puzzle at the moment, because the Office for National Statistics has got a problem with its survey. So the Bank of England is working with one hand tied behind its back a bit at the moment. But it does look as though wage growth is beginning to slow. The sort of the turquoise line in the left chart is their experimental view of what's happening based on the HMRC PAYE data. That doesn't include self-employed people, so it doesn't give the full picture, but you can see that there is a downward trend, and has been a downward trend in that perhaps more robust, but even though it doesn't cover the whole of the market, measure than the experimental ones, which are the orange and the darker green line. But that's still a little bit of a worry for the bank. They don't really entirely know what's going there, but it is giving them some comfort. But on the other side of the labour market as well, we're also other signals that suggest that wage growth is going to become a little bit more under control is the fall in demand for labour. So the growth in payrolled employees, again from the HMRC, so rather than based on the survey that had sampling problems, the growth in payrolled employees is falling, and so the growth in the number of vacancies has also been falling, and both of those suggest that the demand and supply is getting more into balance, and we'll be expecting there to be a looser labour market, which means that we've got more people looking for work and fewer people looking to employ people. So that should have a downward impact on wages. It's not necessarily so happy for those people who are looking for work, or those people who might be beginning to lose their jobs. And we have seen that, particularly in financial services, some significant announcements of job losses. But in terms of inflation only, then that would be good news in terms of reducing interest rates. So if we can have the next slide, please. It looks likely that we'll see interest rates beginning to fall this year, and that was reflected in the market expectations. But the financial markets are a little bit ahead of that. So even though the bank rate isn't falling, we're already seeing falling costs of funds in the markets, in the financial markets, and that's been feeding through into mortgage rates. And you can see significant falls in mortgage rates. These are for fixed mortgage rates, which reflect the lower costs of hedging for banks and building societies who are mortgage lending. So anything on a fixed rate, you can see that the costs of those have been falling, because the costs of hedging and the cost of funding in the financial markets have fallen significantly, because they're expecting bank rate to fall over the next 2 to 5 years. And that's really happy for us, because it means that payment shock won't be anywhere near as bad as we thought it would have been. If you remember from that first slide, there was the expectation that interest rates might have gone up to 6%, and that would have meant much more difficult period for people coming off their old mortgage rates and onto new ones, and might then have had an impact for arrears and possessions and distress sales, which then feeds through into the rate of growth of house prices, pushing them down, and that then affects sentiment, and it affects housing need numbers, all sorts of things. But happily, we're seeing interest rates coming down, and that payment shock worry has fallen away quite a lot. And you can see that the mini budget since November 22, you can see how quickly mortgage rates increased up to there, fell back again, increased again, and now we're seeing those expectations of interest rates really, of future interest rates really impacting on mortgage costs. So can we have the next slide, please? So the impact of mortgage rates and interest rates in general on the housing market is really, really big. Obviously, the cost of borrowing makes a big difference to how confident people feel and how affordable it is to buy a house. Now, that's not to say that affordability is easy at the moment. If we look at house price to income ratios, they're still extremely high, and it's very difficult for people to raise the necessary deposit in order to get a mortgage approved. But once they're in that situation with lower mortgage rates, it becomes more affordable. So we see mortgage rates coming down rapidly, and we're also now seeing, we also saw, as a result of worries about what was happening in the market, higher house prices, the impact of the cost of living crisis, we saw fewer people wanting to move house, and those mortgage approval numbers on the left-hand side, see how that fell away, and how interest rates, when they started to increase in February 22 to August 23, you can see the downward trend there in mortgage approvals. And then again on that same chart on the left, you can see how the rate change expectations and swap rates that began to fall from September 23 and fed into mortgage rates have led to an upward tick in those mortgage approvals, the number of people who are willing and able to move house. And that's suggesting that there's a nice bit of sentiment change, as it were. And that impact has fallen onto house prices as well. Massive fall in house prices beginning after the mini budget, when interest rates are expected to go up significantly. If the impact on the bond markets and overall on the economy had a big impact on the housing market. But now we're beginning to see house prices increasing again. Now that's really at the very low frequency. So we've seen Halifax and Nationwide reporting an increase in prices on the previous quarter for the last 2 quarters. Halifax has popped into positive year-on-year change, but I think that's more of a volatility thing. Nationwide's still in negative territory, and of course you'll have seen last week the ONS numbers on house prices. They're always lagged by about 3 months because they measure at a completion stage rather than the approval stage where the mortgage lenders measure them from. But overall, what I think it is showing is that there's been a tremendous change in sentiment in the housing market as a result of the expectations of changes in interest rate and that pressure coming off in terms of payment shock and affordability. But it's curious, really. It's curious to see this rather rapid change in sentiment when the economy as a whole is still pretty lackluster. Forecasts, well, we haven't been performing very well. The last increase in GDP was up. GDP numbers were up, but they only just knocked out what was the previous quarter's number, and we're pretty close to zero, really. So there's still this concern that we may fall into recession. So this significant change in sentiment is a little bit curious, and it may be a little bit ahead of itself. But we'll wait and see. We'd like to see things begin to pick up. And for that sentiment to improve, because that means that the economy itself will begin to grow more if you've got more construction and so on. Can we have the next slide, please? Oh, excuse me. Overall, national numbers will disguise what's happening in the regions, and regional numbers will disguise what's happening in smaller local authority areas. what we're seeing on the left hand side of that in this map, it's just showing how affordability is much more strained in the southwest than it is further up north. But that doesn't mean to say that we will have that it's easier to buy, or that affordability is low in the north. If we look, for example, in the north, we've got Copeland at 1.96, and we've got Rydale at 4.87, which is closer to what we see in the south of England, where we always know that it's more affordable, less affordable rather, because of the higher issues with demographics and a more transient population and so on. And we can see that was from 1997, and again in 2002. Those stalwarts are still the same stalwarts, even though the rate of growth in the regions in terms of GDP are increasing at a similar rate. We're not seeing those catching up elsewhere, and we can see again that the highest and lowest compared to England tend to be on that north-south divide, all those areas, those coastal regions where we know there is a fair amount of deprivation. Can we have the next slide, please? Now, one of the issues, of course, about housing markets is the availability of new property and the supply-demand balance. Now, we have been in a situation where materials costs have increased really quickly, and that's made it much more expensive to buy things. It's made it difficult for contractors to fix their prices. All of these hurdles that builders are having to get over, plus also them thinking about what's the demand going to be for my product when I come around to selling it. So what we can see now is that even though prices are increasing for materials and for labour, they're not increasing at the rate that they were. So that's some of the pressure is coming off there. But prices are still high, and that will continue to affect the prices and the viability calculations that builders will need to make. And on the planning side, we can see also a signal of what might be delivered is that planning applications granted have been falling on a falling trend for quite some time, and that's been an ongoing perennial problem. It's always thought to be just there, and nobody's going to give us planning for this property, and it's all a bit. It's probably a lot less simple than just planning department delays. There are an awful lot of things in there about availability of land and cleanup costs of land and so on. So it's not all about planning, but that's something that builders like to talk about a lot. Can we have the next slide, please? And indeed, we know that there's not enough property being built in the areas of high need, and the housing delivery tests just have not been met. So we've seen 100 local authorities failing the test, and all of those will face sanction. It's 57%, or sorry, get my numbers and my percentages muddled up. 100 didn't meet the test, and 59 authorities will face the toughest sanction for that, and that means that they'll have to pass all planning proposals that come past them unless they're protected by the National Planning Policy Framework, or the adverse impacts of development outweigh the benefits, so those BCR calculations. But overall, you can see that quite a few of the authorities didn't manage to meet the housing delivery test, and that just shows that we've still got that issue with supply while demand is still increasing, and it's very difficult in the obviously most difficult in those areas of greatest housing need, but those areas that look like they're quite wealthy and so on, they still have housing need, particularly if we want to maintain employment in those areas. So it's a very difficult thing. We do still need to increase supply, and we do need to make it as easy as possible to be able to do that. Can we have the next slide, please? So if you can't afford to buy your own home and you're not in social housing, then you have to look to the rented sector, and that too is in a it's very, very difficult for tenants to be able to afford decent accommodation. Rising demand because people aren't buying in the housing market, and less availability of social housing in many areas means that rental supply and falling rental supply, I should say, are pushing up rents. So we can see median rents in London over £1,500 a month, falling down to just over £500 in the North East. Now that makes the North East seem nice and cheap, doesn't it? But we've got to take into account the incomes that are being earned in that area and average incomes. But everywhere we've seen the rate of growth of private rented sector increasing, and that's making it much more difficult for people to afford to find decent accommodation, and that will put additional pressure on housing need. We can see now that rental growth is beginning to fall. Those three lines, the darkest of those three lines, just shows what's been happening in 2023, and it's a weekly scale at the bottom. So they've been falling for about, the rate of growth has been falling for about half a year, but it's the rate of growth that's falling. Actual rents are still increasing, so it's not getting bad as quickly as it was, but it is still quite bad for tenants. And it's still expensive, so it's still tough for them to be able to get into those the decent accommodation that they need. We have the next slide, please. So just to sum up where we are now, we can see sentiment is changing really rapidly as interest rates are expected to fall, but we do need to be cautious about the pace of economic recovery. That will make the labour market difficult for some people, and wage growth we want to see coming down because we don't want it to fuel inflation, but that also makes it more difficult for people to afford to buy homes. And we have to be careful about the rate of economic recovery. The housing market isn't out on its own, it is affected by those things, so let's just be a little bit cautious and curious about what's going on there. As I mentioned just now, employment and wage growth are key to monetary policy decisions. They're going to make a decision this week. I think Thursday they'll come out with their latest view on their forecast for the economy, and we'll see if they're any less cautious from the latest sets of data. Mortgage rates falling, payment shocks, hopefully a thing of the past, but wages have been eroding for a very long time, so affordability will take a long time to recover. So we don't expect transactions to be increasing really rapidly. We are beginning to see house prices rise again, and the latest forecast suggests that the peak to trough fall will now only be around 4% on a national basis, and that was 8% just 3 months earlier. So you can see that rapid change in sentiment there. Happily, mortgage defaults are low and payment shock not so bad, so that's really good, and that's really good for the market going forward. But we still have high demand and sticky supply, which is pushing up rents. Even though the pace of growth is slowing, we've got problems on supply, both for the rented market and for the purchase market, and the RSLs are finding it difficult to add to their stock as well. So that's all I've got to say now. I'm going to pass back to Hannah. Could we have the next slide, please? Anna's going to talk about what's on the horizon. Thank you.
Well, thank you, Fionnuala. Can I have the next slide, please? So I'm elated that the technology seems to be working. So after around 10% of the audience has responded, we do see that you feel fairly pessimistic about the housing market in 2024. And it's interesting, when we ran a similar poll a few months ago, the number I think was 2.3 with our colleagues. So it's interesting to see that on the ground, even though the kind of the macroeconomic picture, as you will see, it is on the up compared to where we were even just a few months ago, but it is still very much a cautious and subdued outlook. So I think you'll see as we go through the forecasts for the economy and the regions that you will probably be validated in that rather overall pessimistic outlook for the year ahead. Brilliant. Thank you very much. Can I have the next slide? And whilst we're waiting, brilliant, in the next slide, please. We produce these forecasts on a quarterly basis, and we at Homes England source our data from a consultancy called Oxford Economics. So this data we present to you today is our most up-to-date outlook for the economy based on the most recent January data, and that's the central line. We also included the Office for Budget Responsibility, so the official government forecasts that were issued in November after the autumn statement, just for that reference as to how much the sentiment has changed and what's kind of driving it. So you'll see that in some sense, the sentiment is quite consistent between what we thought in November versus what we think now. But in some of them, you'll see quite clear change. And this is quite a good example over here. So overall, even though the outlook is, as we say, a bit better, and we'll show you why in a moment on the housing market side, the overall performance of the economy is still likely to be fairly subdued. So we are anticipated to, of course, avoid recession. So we do not anticipate going into the UK going into recession, but nonetheless, that growth rate will be hovering around zero in the next year or so, and then slowly creeping up towards around 2% yearly growth of gross domestic product. So that's not very rapid at all. However, on the slightly brighter side, on the labour market side, we do anticipate that the rate of unemployment will not increase by much. So despite the fact that we've had that increase in the interest rates that are done with the purpose of increasing unemployment in the economy, to cool it down and to put a brake on the pace of price growth and wage growth, that uptick in unemployment rate has occurred and will continue to occur for another year or so. But unemployment rate will come down eventually to its historically low levels. So by the end of the decade, it should be around 3.5%, just above. And that's, in a sense, a good news, because that means that people's stability of income from their employment is likely to be fairly good. That, of course, bids well for their ability to spend and for demand. Could I have the next slide, please? Brilliant. This is where the story happens, so to speak. So you'll see, first of all, on the left-hand side, that inflation rate has fallen quicker in that bit just before that yellow dashed line. You'll see the drop in the historical data was more than what and that was recorded in this month's ONS release was, and in the previous months, was much more than what was expected back in November by the OBR, and that sent positive ripples through the markets, as Fionnuala explained at the beginning, in terms of the expectations of interest rates. And now we do anticipate the interest rates to remain at the current level for some time. So right now they're at 5.25%. Back in November or October, we were anticipating perhaps another increase to 5.5%, but that seems rather unlikely now. So what we are more likely to see, and this is where the questions arise, is how long will the interest rate remain at the current level? Are we going to see the Bank of England reducing the rates fairly soon in order to curtail some of that rise in unemployment against that picture of rather sluggish GDP growth, or will they remain? Will the interest rates remain at that level for a little bit longer? And we don't know. We don't know what the Bank of England will decide. We'll see this Thursday. I think there'll be a good indication in terms of the narrative whether we are likely to see a cut as expected currently by the markets in the second quarter of this year, so around June time, early summertime. But that remains to be seen. But just before I move on to the next slide, just have a look at how different the expectation has been back in November by the OBR at 4% by the end of this decade, versus now we are expecting around 2% by the end of this decade. Could I have the next slide, please? And the fall in inflation that has been observed and that is likely to continue in the upcoming months and years translates to other parts of the economy. So on the one hand, earnings, usually price inflation, more specifically consumer price inflation recedes, so prices of goods and consumer goods and services, eventually earnings, nominal earnings, so the wage you get paid your employer in nominal terms, not adjusted by inflation, tends to fall off as well. And that, think back to that hairdresser's example. If the prices are falling and the hairdresser no longer needs such high wage to afford the materials, then they will not ask for such a high wage, and therefore the nominal earnings growth will slow down. So we still believe that the earnings will be growing, so it's not that they'll be falling. So see, the rate of growth is still positive, but it's just the pace of growth will be more and more sluggish. And in terms of real earnings, which we do not show on this slide, but if you were to map the previous slide's inflation picture against this earnings growth graph, we would see a roughly positive growth in real earnings for the rest of this decade, but fairly sluggish at around 1.5% by the late 2020s. So that, of course, is on one hand good news, because we have seen erosion of real earnings for quite some time since the 1980s up until fairly recently. But now we do anticipate real earnings to expand, but at a much slower rate than the nominal earnings, of course. And on the right-hand side, we are looking at the costs of the rebuilding. So that is constructed based on the growth of the retail price index. So producers' price inflation, as it's commonly called. And we do also anticipate that fall in the pace of price increases. So again, prices are still set to increase, as we've seen a few slides back, but the pace at which it will increase, it's going to slow down, which overall this picture translates to, on the one hand, lower pace of growth in costs will provide some relief on the supply prospects, and on the other hand, stable, even if slightly sluggish, growth in earnings, nominal and real, will provide also some cushion in terms of housing demand if people's real earnings especially are expanding, even albeit at a slower rate. Can I have the next slide, please? And so overall, what that means on the housing market side is that, as mentioned by Fionnuala towards the end of her section, we now anticipate a much shallower decline in house prices compared to what was thought in November. So right now, the peak to trough, so from the highest value that we have historically observed in the recent years, which was in the fourth quarter of 2022, to now what we anticipate to be the lowest point in the cycle, after which house prices are believed to be expanding again. We now believe it's going to be by the end of this year, Q4 2024, now believed to be at -4%. So still expecting a price decrease in terms of housing, but not as deep as we thought a few months ago, and troughing sooner and rebounding sooner than we thought. And this is pretty much that change in sentiment can be attributed to that change in the pace of falling consumer inflation being much better than expected, and therefore the interest rate being lower than initially anticipated. So that feeds through quite strongly on the house price side. Nonetheless, looking at the transactions and starts, so the activity actual in the market, again, while we do not foresee such low levels of both transactions and starts in the near term, so in the next year or so, as was thought in November, nonetheless, you'll see that the number of transactions, because of that mounting ongoing pressures on households' finances from the cost of living crisis that's just kind of passing or resolving itself very slowly, and as the higher borrowing costs are continue to be felt, even if they're falling, but they're falling more gradually than they went up. So you'll remember that the bank rate went up quite steeply, but the projections for the fall are much more gradual. And because of that, we do anticipate that for some time on the demand side, transactions to be lower than what we were used to in the past few years, and eventually reach the levels that we had seen in the late 2021, early 2022, but only towards the end of this decade. And curiously, on the start side, and I'll let my colleague Fionnuala talk about this in a bit more detail in a moment. On the regional level, you'll see that ongoing pressures that relate to planning, land availability, availability of skilled labor, and so on. Those issues keep the levels of starts we anticipate below what we have observed recently. And while we again do not anticipate such lower level of starts compared to what we thought in November, nonetheless, the overall picture in terms of house building activity is fairly subdued, and perhaps this is where that audience pessimism may be coming from, because you live and breathe this, and this is what kind of the aggregate picture shown up here. And last but not least, in the private rental market, we do anticipate private rents growth to cool down because of the affordability ceiling. So landlords needing to lower their rents in order to keep up occupancy on their properties. But nonetheless, that should be fairly short-lived, and we do anticipate rents to keep going up in the future because of mainly ongoing pressures on demand from poor house buying affordability and sluggish supply of rental properties. Can I have the next slide, please? And I'll hand over now to my colleague Fionnuala to talk about the regional outlook.
Thank you very much, Hannah. So we have some regional forecasts here, so that the national numbers sort of disguise what's going on in each of the regions. Can we have the next slide, please? Okay, so overall, across all of the regions, the expectation is that GDP growth is pretty similar across each of the regions. But then that doesn't mean to say that they're all operating at the same level. Regional income divergence is still quite large. So this chart here shows you real disposable income by region in pound terms. So you can see a really, really big difference between the northeast and the southeast there. And that's just reflecting the overall wealth because of the concentration of businesses, the most highly paid jobs, and so on. So even if growth, the GDP growth in each of the regions is the same, it doesn't mean to say that they will all be as wealthy as one another. And what the forecasts are telling us, looking forward from 22 to 2028, is that real disposable income growth forecasts also diverge quite a lot. But again, it's those wealthier areas that we're expecting to see the largest increase in disposable income, and the poorer areas to see the smaller growth in disposable income. And that will be telling us something about where the investment is going. It will be telling us something about where there is more certainty. It will be telling us about the skills levels in these areas and the levels of uncertainty that there are. And of course, as we come up to an election, there's going to be a lot more uncertainty. But if you wanted to change that difference across the different regions, it would take an enormous change in policy to be able to achieve that, and it would take an awful long time to do that as well. You would really need to almost reverse what is happening in terms of government spending in each of the regions and move the city up to Newcastle to do those things. So it's not realistically ever going to be the state where we get complete levelling up. And when as we move towards that, then it will take some time for those gaps to close. Can we have the next slide, please? Now, obviously, the wealth of different regions will have impacts on house prices, as does the demographic have impact on house prices. And the north-south divide still persists. We can see that growth in house prices from 2010 to up to the peak in 2022. It's the same old story. London and the east and the southeast. As you move down the country, you can see the rates of growth getting lower, all positive, of course, as we've gone through a nice period of low interest rates, which has helped to push things along. But definitely those the stalwarts are still at the bottom, and the stars, not meaning anything by that, but in terms of house price growth, are still the same ones as we would have expected. But the northeast does stand out as the least volatile region. If we look at the forecasted peak to trough in prices between Q4 22 and Q3 2025. We haven't got the regional forecast quite right, the latest set of regional forecasts quite right, so that's why it doesn't look like it's a 4% change. But the order rather of each of the regions is still in the same place. But talking about the northeast, so it had the smallest increase in house prices, but it's also expected to have the smallest peak to trough fall in prices. Now that just reflects partly the level of activity in that region. It also reflects the demography. It also reflects affordability in that sense. It's less unaffordable there than it is in other places where we see the peak to trough falling significantly. I always think that the east is it's an unhappy region in some ways. It benefits a lot in terms of house prices from being close to London and being commutable to London in many ways. And you will always see that prices in the east grow very rapidly when they grow in London, and they're one of the first regions to pick up, but also they're one of the first regions to take a hit when that happens. Something of an overshooting perhaps, but that's still the same expectation, is that the eastern region will fall more than anywhere else. The Midlands, that moves around a bit, and the northern regions generally less volatile than the southern regions, but a smaller fall in prices in the northwest is anticipated. But again, we're going back to the earlier slide I showed you, that affordability in the north is relatively good compared to elsewhere, but it masks wide differences within each region, and you have those pockets within those regions where affordability is really poor, and there'll be need for some help there. So can we have the next slide, please? So Hannah was talking about the availability and of starts or new starts and what's happening there. And starts are suffering everywhere in the near term. Recovery slowest in the northeast and Yorkshire and Humberside. We can see the forecast change in total starts for 2 5-year periods. So what happened between 2019 and 2023 compared to what's expected to happen in the subsequent 5 years. So those expectations of house price corrections and slow GDP growth, higher interest rates and demand, they affect everybody, but they just affect them in slightly different ways, but they still affect everybody. Just as the national thing aggregates, it affects all of the regions similarly. Once rates begin to fall from around mid-24, we're expecting starts to begin to pick up, but they're still over 5 years, they don't achieve the levels of the previous 5-year period, still significantly lower. And for England as a whole, still -12. Better in the southeast, southwest and the eastern regions, where they're not expected to fall quite as much. Again, that's a demographic sort of a proximity to the most expensive areas, and proximity to the most expensive areas, and those with the travel to work areas into more highly paid occupations. But we're not expecting a great deal of recovery in Yorks and Humber or the northeast, and that's probably reflecting also those changes in real disposable income that are expected. Next slide, please. So overall, we've got an economy that is, in terms of GDP, it's not flying. We've had a very stagnant period. We're not expected to pick up significantly, but that change in interest rates has had a big impact on sentiment in the housing market, and that's causing some uplift in demand. It's not clear how long that will last, but it has made everybody feel happier, and there are some good signs about the arrears and forced sales, which will take a great deal of pressure off the housing market. But we've still got problems with affordability, both in the rental market and in the purchase market and the new build market. And with that sentiment, with affordability still low, then that will affect the viability of sites and the possible delivery that's available. But overall, it's trotting along relatively nicely, but at a very slow pace. So we're not expecting to see growth in the housing market in terms of both supply or in terms of demand at anything like the levels that we saw when interest rates were really low, precisely for that reason. And people are beginning to adjust now to higher rates and and something of a bit more of a normal situation with interest rates. So that's all I've got to say. I think next slide, please. And I think we might have some poll results, perhaps.
That's right. Excellent. Thank you, Fionnuala. So Fionnuala summed up the outlook really well, and the last kind of poll on this topic, there will be one more at the end on this, two more actually at the end. So the third to last poll that concerns your thoughts on the market outlook. We'd really love to hear what you think is the key market challenge that's facing your part of the business. So if you have taken part in the poll at the beginning on the sentiment, you should be able to just scroll through the slide to this one. It's exactly the same code. If not, then you have the details here. Yep, please feel free. Next slide, please. So as Fionnuala has said, I think she summed up really well. So here are just a few more thoughts on the kind of wrapping up the outlook and kind of the both the macro and the regional picture together. So as mentioned, trends in growth at the economy level are likely to remain subdued, but they're quite consistent across regions. Nonetheless, the level gaps in wealth and income and employment are very difficult to close. And even though we do anticipate a growth in real incomes in the next few years to happen both nationally and across regions, the pace of it's quite different depending which part of the country you're looking at. So places like Northeast Yorkshire and Humber East Midlands expected to experience the slowest growth in income, and that of course translates to the outlook for house prices and the overall growth. But places like West Midlands, from kind of the Midlands to North regions, expected to perform relatively well in terms of growth of income as well as in terms of employment. Which we haven't showed you on the slides, but our analysis point to that as well. And in terms of the housing market outlook, on the one hand, the outlook for prices is much improved, although again much varied across regions, with the deepest contraction anticipated in the East and the West Midlands, and the lowest in the Northeast. But again, that interpretation of that has been very skillfully given by Fionnuala. So I'm not going to go into too much detail here. Nonetheless, even though the outlook for prices is improved, the outlook for new building is much less positive. We still anticipate some growth in transactions and starts, but the level, especially for private sector starts, are not anticipated to recover to the levels we have seen historically between 2019 and 2023. And on the rental market side, we do anticipate some relief to the current record high pace of private rental growth. And even though we do anticipate that private rents will continue growing after that dip initially in the next year or so by the end of the decade, but the level, I believe that the pace of growth will not be as rapid as we experience currently, which should provide some relief somewhat to the private rental sector. Although, again, that does not mean that the situation is good. The outlook is still very much quite cautious here. So if I could have the next slide, please, which I believe should be our results. And I think they may not be loading, but we do have a link that's going to be sent momentarily in the chat, or maybe already has been sent. And it will be included as well with the slide pack. I'm looking at it now on my device, and I see quite a few very interesting things. So I do hope that you'll be able to see it in the chat, but following the link to see the results. So we'll put that up in a moment. But the key thing around what you seem to be worried about concerns affordability, both on the house buying side and private rental side. Inflation and the cost of borrowing and financing are also quite prominent. And that affects concerns on viability uncertainty. So I think it's a fairly consistent story, and we'd of course would love to hear every single one of you who has responded to the survey talk more about why you put that. But of course, this is not the time and the place. But we're very happy to hear some questions and comments in the Q&A that's gonna start momentarily. So if we can go to the next slide. So we have been monitoring this slide throughout the session, and we've picked the most popular questions that you've put in the chat during the presentations that we're going to be asking our panel. So I believe we're going to turn the slides off, and see Fionnuala's already appeared on the screen. So we do have a few questions. I'll take a couple, and I'll start with Fionnuala as well. Some of them may have been covered, Fionnuala, but perhaps just require a little bit more explanation. Some of them I think maybe have not been covered. So the first question is on the bank rate, and the question is, if the base rate remains at 5.25% for some time, will mortgage rates decrease or stay at the same level? So of course, at the moment, you've seen that the expectations are of falling, but what if the bank actually keeps that high rate of interest for longer? What is likely to happen then?
Would you like me to answer that? I'm just getting
yes, please.
Yeah. Well, I think it does depend on how long the markets expect interest rates to stay at that level, and that will depend on what's happening with inflation and what's happening with the labour market and what's happening with the economy at large. So if we see the economy beginning to move into recession, for example, then they would expect, and if the economy is expected to go into recession very quickly, then they would expect interest rates to start to fall more quickly than otherwise, and that will then feed through into swap rates and funding rates on the markets, and that would feed through to mortgage rates. But if we're in a situation where we think that inflation is staying where it is, that the interest rates will have to stay relatively high, then they will stay at that rate. The mortgage rates will stay where they are for a bit longer. But it's not ever going to be just a completely stable situation, because we're not in what we would call as economists an equilibrium. We've still got inflation running a little bit high. We've still got wage growth running a little bit high. We're not expecting GDP. Well, GDP at the moment isn't at its most. We're not producing as much as we should be doing for an economy of our size. So we still need to see some rebalancing in the economy as a whole, and interest rates are part of that. So it's only when the markets are happy that things are moving in the right direction that they will alter their expectations of interest rates. That's quite a complicated answer. I hope it does make some sense, but it depends on lots and lots of different things. But keep your eye on the economy and you'll get an idea.
Thank you, Fionnuala. So I'll go in the order that we have the most popular question. So I thought perhaps you'll be a good one to answer that as well, because I think it was covered partly in your section, the first section. So the question is, what impact will fiscal drag have on growth forecast and the overall outlook that we've presented?
Well, I think the impact of fiscal drag should already have been taken into account in the forecasts that we've presented, because they're all in the public domain. And the OBR numbers, even back then, there was an expectation of what would happen to tax rates, and those will also be included in the forecast that we've got now. But overall, or the general thing is, if the tax take increases, which is what happens when you have fiscal drag, your income increases, but the tax threshold doesn't, so the government is taking more tax off you. So if the tax take increases, it reduces the amount of money that you have available to spend. And if people have less money to spend, then the hairdresser doesn't get paid, and so then the hairdresser can't go and buy some potatoes or whatever, and so it reduces how quickly the economy can grow. And if the economy is not growing quickly, then we get the situation where companies aren't comfortable about investing, and that uncertainty reduces investment, so we're not as efficient, so we don't grow as quickly as well.
Thank you, Fionnuala. So a couple of questions coming after that, which I'm happy to take. So I'll take the easy one first, and then I'll do the more challenging one. So first, the more straightforward one, there was a question whether the Oxford Economics regional growth chart includes the Southeast. So the the Southeast would be treated separately. So the figures that we've shown throughout the presentation would be excluding London. We've included London on the graphs, but on the I think with the disposable income chart, we did not include. So for the disposable income projection, in case that person asking that question is interested in London specifically, so we do the forecast for the growth rate in real disposable household income between 2022 and 2028 is around 10% growth, 9.7% for London. And that's, of course, much above the England average, which I believe was 8.4% in that same period. So that kind of continues that story of the big challenge that leveling up has to grapple with, which is that those we do anticipate in the near term at least those gaps to persist because of the uneven pace of growth in incomes. So that was the straightforward one, and the second one, which I think, Fionnuala, please feel free to chip in as well. But there are two questions that, and I think probably even more because I'm looking at the most popular ones about the general election and the impact it will have. So there was a bit more general question on what impact do we think the election will have on the market, and a bit more specific one related to it, which was, will there be any changes to house prices that are caused by the lead up to the general election? So the general election is likely to take place this year or very early next year. Well, that is a fairly, I'd say from policy perspective, I'd be fairly cautious in terms of how much can happen in that time. I think that the bigger story here is what the Bank of England will do, and that, of course, they're independent of the government. So general election or not, they're going to make the decisions based on their own analyses. And so what we have seen is that this is more likely, I believe, to govern what's going on with house prices. In terms of the housing market at large, again, I'll be cautious. Of course, we at Homes England, we're not responsible for policy setting. That's the Department of Levelling Up Housing and Communities job. We are responsible for delivery. So on the one hand, it's difficult to tell what the policies will be announced in the spring budget. We do not know that. However, what from our kind of professional capacity, I think what's fair to say is that it's a very short time between the announcement of the policies and potential implementation stage to the general election time, which is a matter basically of a few months' time. And so I do not believe that the impact will be as substantial as compared to what's going on the monetary policy side. So of course we'll see some activity, but I would still be fairly cautious, and I would still probably look more to what's going on with the Bank of England and what they're reporting on and what's their outlook, because I do believe that's a bit of a better indicator. Fionnuala, please go ahead.
Hannah's exactly right. She's exactly right. What's happening? The government will be constrained to a certain extent because of what's happening with monetary policy, and it needs to chart a very stable course as far as it can. I suppose the thing with policies that come up around election time is they can be a little bit populist, and I think we see how quickly changes in announcement to stamp duty make an impact on housing markets. If they were to introduce something like that, which I sincerely hope they don't, would have a very quick impact on housing demand and then on house prices. I think it's important to look at what's coming out of the manifestos, particularly in terms of housing policy. But as Hannah says, it's their oil tanker type things. How long does it take to get a site up and running and to be able to be sold? So all of these things will take time. There's usually a little bit of uncertainty around election time, but given where we are and the uncertainty we've been dealing with so far, I don't think it's enough to cause things to stall or to take off. I think Hannah's exactly right there.
Thank you. So the next question, and we have quite a few of these popping up, so thank you so much. concerns planning. So as a planner in a local authority looking to improve our poor housing delivery figures, the person is asking, are we actually just at the mercy of national and regional market forces? How effective can local planning policies actually be? And I think, so I'm happy to start, and then Kunal, if you want to jump in. So I'd say that I wouldn't go as far as saying that you're just at the mercy of what's going on in the market. I think this is the context within which you are operating, and that of course will have major impact on what's going on. But I think also the extent to which different elements of the market move will also have kind of varying implications. So, and it of course will vary by where you are, so the region and local authority you're operating in. Things like costs and borrowing costs, product costs, labor costs, of course, they have been on the headlines, for the past year or so, and that's had a very major impact on everyone planning and house building and the economy at large, partly because or in the context of the fact that we did have very low inflation rates for quite some time since after the global financial crisis. I mean, who remembers a few years ago we were talking about potentially a negative interest rate by the Bank of England? How far are we from that now? But I think as now the outlook for costs is improving and is likely to stay fairly contained, that stability, I think, to that part of the market, I think, would provide some respite in terms of how the market forces affect the local planning. But I don't know, Fernand, if you want to add. I mean, am I being too optimistic?
Well, I think also a lot of, if we think about our environment, a lot of that is local, and so it can make a really big difference if your planning policies can mean that you can release some land that isn't too controversial, and you can build new homes to be able to alleviate any housing need problems that you might have. So obviously the wider economy and what's happening in the wider housing market across the whole of the nation will affect sentiment to a certain extent. But remember, many of these projects are so long term, and they take a long time to go through that planning process. It's not necessarily the developments in the economy or what's happening in the housing market now that make a difference to those decisions to go ahead. Obviously, there may be slowing down in the rate of build that are affected by market sentiment and so on. But the initial plans and granting of planning shouldn't be affected quite so much by what's happening in the short term forecast. And many of those things also are outside of what's just the economy. They're to do with housing need in the area, the availability of transport and all of those sorts of things, which you'd know an awful lot more about than I would.
Thank you, Fionnuala. So there's another next question that I think maybe you can start with as well, because I think you'll be the expert on that for sure, is on house prices. And the question is, do house prices really reflect the current situation in the housing market? With limited production, prices remain high, posing a challenge to affordability. However, we also observe a significant task in decarbonisation and addressing damp and mold problems. Do we see sufficient correction in house prices in that context?
I think there are quite difficult situations here. So we know one of the reasons why house prices increased so rapidly when interest rates were low is that housing is always seen as to be an asset that beats inflation, that is a good asset to hold. It holds its value generally. And there were fewer alternative assets that you could invest your money in and get anything back in terms of the rate of growth of house prices. And of course, the more people invested in housing, the more that pushed that up. Obviously, we're seeing some correction now. But to the extent that they reflect the current situation of the housing market? Well, of course they do, because that's what we're seeing day to day. and we're seeing that in terms of transaction activity. But that might also mean that price, say for example, prices are growing quickly now, but mortgage approvals or mortgage demand is still quite low. It's what's being captured in the measurement. So it might only be a small proportion of the market that's seeing increases in house prices, just because there hasn't been a great deal of transaction going on. But certainly in the sector of social housing and RSLs, in terms of the supply of new housing in those sectors, they are under considerable constraints in terms of investing in new housing because of the regulations that affect the quality of housing in their own stock, and that will reduce the amount of money they have to be able to develop new land and to be able to buy bulk purchases from builders to improve their overall housing stock in their area. Now they have the social housing, the social landlords and councils who provide their own housing do have they do have regulations in order to make them do those things. So they've got a greater pressure on them. That's not necessarily the case in the private sector. And in terms of the private rented sector, of course, housing standard is really important, and but it's not as easily regulated as elsewhere. So in terms of rental prices, if you've still got a lot of demand, even if landlords are supposed to be spending more money on decarbonisation and insulation and so on, you're still going to get somebody who wants somewhere to live who's prepared to pay for it. So I think yes, there's a definite impact on regulation, certainly for RSLs and local authorities in making sure that housing is up to standard, and that's a bit of a longer term thing in terms of the supply of new housing and what they can do in terms of the supply of new housing. In the private sector, transactions and what's happening in the wider economy is probably a bit more fast moving, and that tends to be what's measured by the house price indices, is private sales.
I hope that's really comprehensive. Yeah, very comprehensive answer. Thank you. So I'm happy to start with the next question. So the next question, one of the most popular ones, is as follows. So the question is there a delivery lag in the house building industry which is now starting, or has it already started and soon to recover? I.e. developers are building out the sites they have permission for but are pausing on their projects for the next couple of years. So this is a very interesting one, and I think that the answer here will depend on what kind of developer are you. So we've had in the past few weeks, even I believe, trading updates from, for example, some of the large volume house builders, and overall those are fairly positive in the sense that the does seem that they're continuing with the activity. Some of the stats are lower than what they have seen this time last year. For example, the observed sales rates. However, looking ahead, kind of on the sectoral level as well, the latest RICS residential survey that comes out every month to gauge sentiment has been fairly positive as well, after quite subdued or gloomy results over the past few months. So in terms of, for example, sales outlook, the expectations for even the next 3 months are, I think, the best result in that RICS survey since mid 2022, and the 12-month expectation of sales is much improved as well. So I think that it is, for kind of the average level, on the one hand, we certainly, in terms of the lag in completions, we do know that that tends to follow the start statistics. However, on the kind of average level, it does seem that the kind of lull in the market is being weathered fairly well. Having said that, again, at the beginning of my answer, I mentioned depends what kind of developer you are. And of course, if you're a small or medium house builder, your conditions, your context will be completely different. And I think that it's much more difficult to say much more difficult to say that the outlook is so positive for that sector. And Homes England is engaging very much behind the scenes in terms of trying to understand the challenges that the sector is facing, both those deep structural challenges that we hear about frequently from different surveys of the sector, like around planning, land availability, but we're also looking currently at the market itself and how the market challenges, the market forces affect SMEs differently to volume builders, and how Homes England can intervene better. So this is the work that's ongoing, and we do not have definitive answers yet. But as you work with us, if you're an SME developer, if you're working with us, you'll for sure have a say in that, and would love to hear reviews as well on that through our kind of regular engagement routes. Brilliant. So if you don't want to jump in, which you don't have to, happy to go to the next questions, really well. Which again on house prices. So I think you're our expert on the topic. So the question starts with a statement: we are starting to see new homes marketed on the basis of their energy performance. How long do you think before the general house price indices will genuinely reflect running costs, making it worth investing in upfront low carbon, high efficiency projects?
Oh, that's a tricky one. These things do take a long time to feed through into the general market. Things may have moved on, but it used to be the case that the RICS valuation guidelines didn't include very much on things like insulation or eco carbon neutral movements, or passive houses. And I think in terms of the general housing stock, there needs to be some reflection in the valuation that comes from a valuer that would start to move that forward. That will take some time. And we are beginning also, though, to see more ingenuity from lenders in terms of lending to property owners to improve the eco-friendliness and to improve the insulation, to reduce running costs of their homes. And more and more innovative products in that sense are coming onto the market. Now that obviously is partly because fuel costs have been so high and people want to reduce their fuel costs. When how quickly that moves into the overall valuation, I think it will be quite slow, but it is at the margins where everything happens. If you were looking for a house now, I think we'd be asking the question about how well insulated it is, do the windows need doing, and take a little bit more of a closer look at those things than perhaps we had in the past.
And just a very quick comment on that, because of course, price. What is a price? We're both economists, and they're both economists who spend their whole careers to trying to understand what the price actually is. And of course, you need to remember that costs will be a very important part of how prices are set, but they'll include a variety of other factors that mainly, will inform viability and profit, and other things like that are completely, part of, every type of price, whether house price, any other one. So I think that, looking at, of course, also how prices are constructed and how they move, and there's lots of very interesting research out there that explore this topic. I read something very interesting on exactly this topic over the weekend in Ireland, in the Irish case, so completely different than England, but nonetheless a very, very interesting analysis, just show how complex house price setting is. So I think there's just something to keep in mind as well. And the next question, happy to again start with a very good one, a very interesting one, as all of them are. If we started delivering 300,000 homes per year, how long would it take for increased supply to start having an effect on affordability? And I think that's a very difficult one to answer, but one thing to keep in mind is that as the first, for this, right now we're in a situation where we've had quite strong policies in the past years supporting demand. So Fionnuala mentioned earlier the stamp duty, policies like Help to Buy, that's wrapped up recently. So these type of interventions have affected the demand side of the housing markets by increasing demand, and that of course is somewhat of a legacy of what we're dealing with now in terms of that high demand for housing. However, with increased supply, it again is all about that relative movement. So it's hard to answer how fast that increased supply will start having an effect without knowing what's happening to demand. We know that while, as mentioned, in the past years, housing demand has been very strong. In the most recent couple of years and months, demand has been weakened because of the entire outlook we've talked about, high inflation, high borrowing costs, and the outlook for demand is, at least in the near term, is still fairly subdued, but expected to recover gradually. So again, it all depends. If demand were to stay fairly subdued because of the kind of ongoing market impacts that we've discussed today, and we suddenly had that upshoot in supply, then the affordability benefits would be felt fairly strongly, fairly soon. Again, relative movements. However, if demand were to rebound, be it to other new demand side policies being introduced or population growth, whatnot, that means that the pace of that catch-up may take longer. So I think it's all about that relative movements on demand and supply, and it's important to, if you're interested in that, to kind of read up on both what's going on the supply and demand side to have an idea of how that could go.
I think that's dead right, Hannah.
Go ahead, please.
I think also one of the things that we've been a bit surprised at house prices increasing at the moment when everything seems in the economy to be relatively subdued. So to a certain extent, it depends on the amount of pent-up demand that's still there. And if the availability of new homes is more prolific, then you should be able to have more competition. There should be able to be a bit more negotiation. So some of that will depend on the amount of pent-up demand. If there's a lot of it, then you're not going to see a huge amount of difference on house prices. But if there's not very much of it, then you will.
I think just one last thing on that. I think another interesting thing is all about the diversity of the market. So while we quoted here the average affordability statistics vary geographically, there'll of course be different types of buyers, and affordability for first-time buyers has been quite poor, and of course looking also at the distribution of income, like poor to kind of low to middle income households, of course, face much worse affordability compared to high or middle to high income households. So I think it would all depend how that policy would be installed and what measures would there be, because there may be measures supporting demand, but varied and refined by those different market segments that have the poorest affordability at the moment. So again, I think it's another kind of interesting food for thought rather than a straight answer. It's all about that diversity as well, kind of looking how that mechanism operates rather than just looking at the kind of the average effects. So we have, I believe 2 more questions, and I think that's probably will be the end of it. So thank you so much for the discussions and loads of questions that are coming through, but I think we'll probably just finish off with these 2 looking at the time. So the next penultimate question then is on what is the impact of world events and foreign real estate crises on the UK market? Nofino, would you like to tackle that first?
Oh, well, that's a big one. That's a really, really big one. The global economy, of course, affects all of us. US being the largest, well, just about the largest economy. I think has China just overtaken it? But just about the largest economy has a big influence. And some of that is to do with investment flows rather than other demand things. And I think that's where the international context is most acute, really. So if you're an investor in real estate, then you're looking to where you're going to get the best returns. And if you've got more less confidence in what's happening in the States, you might look at somewhere else to get to address your risk appetite. And you may look to somewhere a bit more stable. They might look to Europe, to probably less to Germany now, but to France, for example, where they might think that things are a little bit more stable. So of course it does have implications for housing markets, more so on the commercial side of things, or in large, probably in the build to rent sector. But I think it's a volatile global economy at the moment. Everywhere is seeing some uncertainty and constraint on on activity and growth. Supply, the geopolitical unrest, the impact on supply chains from the attacks in the Red Sea are making a big difference, and they will affect, once again, supply chains, and that has implications for our builders and the cost of building and so on. So I think it's a hard one to know what the exact answer is. We just have to say, yes, it will have an effect on relative attractiveness of the UK compared to other areas for investment flows. It will also have implications for the UK economy more widely because of the changes in exchange rates. So if there's a confidence in the US economy starts to fall away, then you might expect its currency to fall, and that will be in our favour. That might be in our favour in some ways, in that we can. People might see us as a more trusted place to hold wealth, and that would push up our exchange rate. But it also might mean that it's easier to import things from the States, and that has a negative effect. So everything, I'm afraid, is a bit of it depends, and it could change at any moment. But I think the biggest thing is really those investment flows.
Thank you, Fionnuala. And then the last question, which is the following: can you briefly summarise how Homes England can help address the viability gap to improve housing delivery in lower value areas? And I've just seen another one related to also quite a few likes. Have Homes England modelled the effects of the uprated building regulations in 2025? So overall, I think this is, again, a very big one, and could probably have another winter learning program session devoted entirely to just this question. So I'm going to try to be as brief and informative as I can. So we have recently moved to a place-based working model. So we do have very strong focus on the different regions, and we pay equal attention to those different regions in terms of our interventions and what we do. So there is very much that expertise, and if you're a partner in a lower value area, if you ask that question, we do have routes of engagement that allow to to find out what's going on at Homes England and how you can input your views into what Homes England is doing. So if you're not yet plugged in on these, then please reach out to us, and we have various avenues of engagement that as a partner you should have access to. But in terms of the other measures other than place-based working, we have recently also scrapped the 80-20 rule, which used to be in place to target areas with affordability stress. So as mentioned, now it's much more focused on the different regions, the understanding their individual challenges, and focusing on regeneration and placemaking rather than just the numbers, delivery numbers. And this is part of our recently launched new strategic plan. And we do have a range of programs and interventions across the country. So depending on what part of the sector you're in, whether you're a small, medium house builder, whether you're in the build-to-rent, private rented sector, it really depends on where you sit. And we have different programs in terms of funding, financing, support. In places we do also take on that more active role in home building. So most, I think, prominent example now we're working. One of the most prominent examples is York Central, where Homes England has entered joint venture with National Network Rail and a developer to really regenerate the previously neglected area, and that's of course in York, which is one of the those areas that perhaps overall there are very big challenges in terms of delivering sufficient number of homes. So it really does depend where you sit in the sector, because we need to know what the barriers to delivery are that you are experiencing. So as mentioned, there's more on our website in terms of the support we offer. In terms of the building regulations, it is a work that's ongoing. So we have research ongoing on that very topic. It's still in progress, but we should have more to say about that in a few months' time. So we're almost there at the time. You've asked excellent questions, and there's so much more in the chat. So thank you so much for that. I'm going to wrap up now. So if you can have the slides back, please. So here is a very a bite-sized overview of the session of resources. So you'll have that when you get the slides. So thank you very much. This is it for today. I will send you the slides in due course, and you'll also be able to catch up with the recording of the session in the near future as well. So thank you very much, and goodbye.